Let me know when you can see my screen.
We can.
Right, so let me focus on admitting some people here. Well, thank you. Thanks so much. All right, so good evening, everybody. Good afternoon, depending on where you are. Thank you for joining the Wealth Mindset and Real Estate Investing virtual meetup. So my name is Chris Price. For those of you who I have not had the chance to meet, I'm the host of the Wealth Mindset and Real Estate Investing meetup, virtual meetup here, and I'm also the CEO and co-founder of Red Fox Multifamily. So let me share with you a little bit about us. So the Wealth Mindset and Real Estate Investing Meetup is open to all who are interested in growing generational wealth through passive real estate investing and increasing their financial intelligence. This meetup is for the busy professionals and retirees across various industries. The individuals in the group make a good living, and they have discretionary income to invest in real estate for its proven wealth building power, but they oftentimes don't have the time, skill set, or network to do it at speed and at scale. And so this meetup focuses on helping us all grow our wealth mindset by learning how to build and preserve wealth while developing and maintaining an abundance mindset. This meetup will focus on multifamily real estate investing as well as other proven ways to build wealth through real estate investing through passive investments. So for today, just a little bit of logistics that I'd like to start off with as we get started here. So I'd like to ask that, if you're not speaking, to please mute your lines so that we can reduce the background noise. I also like to ask that if you could, hold your questions to the end, but if something's really burning and you want to get it out, please do feel free to use the features in the meetup to either raise your hand or to just take yourself off mute and ask your question. As I mentioned just a moment ago, this presentation will be recorded, what I also want to make sure that people know is that this material does not constitute an offer or a solicitation to purchase securities. This is information only and should not be construed, as business, financial, or legal advice. And what for those of you, as I mentioned, who I haven't gotten a chance to meet with yet, or this content that you're talking about, that we're talking about today, interests you, and you want to learn or talk more about real estate, or just on wealth mindset, or just exchange to get to know each other, please do feel free to scan the QR code on the screen or email me at chris@redfoxmultifamily.com, and I'd be happy to set up some time with you to chat and discuss and learn a little bit about you and share a little bit about me, and see if we can build a friendship. So as far as our agenda today, we're going to do a brief speaker introduction, and then I'm going to hand it over to our speaker, our special guest here, and then we'll have a Q&A for a few minutes, and then we will have, time permitting, virtual networking just for folks to share contact information, set up meetings, make arrangements, however you see fit, just to use the last few minutes of the meeting to be able to do that. So let me go ahead and introduce our speaker today. So our speaker this evening is Anderson Nogueira. He and his wife, Anna, have founded Multifamilypedia to help successful professionals and busy entrepreneurs to create and grow a stream of passive income through multifamily investing. They have started investing in real estate in 2005, and the focus at that time was to reinvigorate urban areas as building modern looking duplexes. Besides that, they also invested in buy and hold single family homes, and soon realized that it wasn't scalable enough to achieve their financial goals. So they have transitioned to multifamily apartments. And since then, they have invested in over 1,200 units between Texas and Alabama, and are members of Multifamily Mastermind with another 200 multifamily investors. And if I could add just a personal tidbit here about Anderson. Anderson and I had a chance to meet back earlier this late spring in Dallas at a real estate investing conference. And this conference was so lively, a lot of great information, great, tons of people there. And during one of the break sessions, I was walking through the big auditorium, and I see this man, and he's standing there, and we catch eyes, and we ended up just having a great chat, a great opportunity to connect and learn about each other. And from there, we were lucky enough to go out and have dinner that same night with some other investor friends of ours, and we all struck it up and had just a great connection. And when I tell you that Anderson is a genuine, one of a kind individual, I truly mean that. He's helped me. He's helped me so much on my journey in this space that he, in such a short amount of time, I couldn't tell you. But he is just such a great person, authentic to the core, and I really appreciate him taking the time out to educate us this evening on this very interesting topic that we're going to talk about here around reducing your tax burden and growing your wealth with multifamily real estate. And just briefly one more thing before I transition it over to Anderson, what we should all be focused on as we think about our finances and our personal economies. One of the top things that I've learned, that I know Anderson has learned in becoming more and more financially intelligent, is that taxes are likely the biggest expense that you, me, everyone on this call will ever have throughout our entire life. And it's critically important that that as individuals, that the key to properly managing these taxes is to make sure that we balance our income and our investments. And no, there are very few investments other than multifamily real estate, and is more than likely the best investment that has several tax benefits. And it is one of the most significant uh, asset classes that you can leverage for its tax advantages. And there are others out there, but multifamily real estate is one of those at the top of the list. So without further ado, I'm going to stop sharing, and I'm going to hand it over to Anderson so that he can share with us um, uh, some information about reducing our tax burden and growing our wealth with multifamily real estate. So Anderson, I'll pass it over to you.
Hi, Chris. Thank you very much. Can everybody hear me well? Thumbs
Yes.
up. Okay, and you guys can see the screen as well, right? All right. All right. Hey, Chris, thanks so much for your words. I really believe in relationship and people and connecting. Hey, if you're just open to that and you're very intentional on what you want to achieve, where you want to go, I bet you're gonna find a lot of people along the way that you can connect and can learn from each other. I also learn a lot from Chris, and it's great to see people here, right, in this forum at this time of the day, the evening, dedicating your time to learn more and improve, right? That's just phenomenal. So very quickly, just a quick disclaimer. I'm not a CPA, I'm not a financial advisor, I'm not a lawyer. What we are going to share here today is really on an investor perspective, what I have learned, what I have done, and my opinion about that. I believe that can be helpful for a lot of people, and I hope that is helpful for you too. And you'll learn a few things today that might help you string your strategy to grow your wealth. I just going to skip this. Chris just introduced us. Just sharing some assets that we have invested as far as multifamily. We see in the top left a property in Huntsville, Alabama, and then you see other three properties. Each picture is a different property here in this slide in Texas. I like very much the market in Texas for a lot of reasons we're going to discuss, but essentially the fundamentals in Texas in terms of population growth, household formation, right, and jobs growth is very robust. And I think these last 2 years, we got a lot of migration coming in, right, as other states like Arizona, like Florida, and I think that just bolstered the demand to a whole new level. So these markets are very, very, very robust. This was the last property that we closed back in July. This is in Houston, Texas as well. That's a big one. We got, a number of partners here, but super happy with this asset. We are just starting getting our hands on and start turning this asset. I want to start from what we might be seeing on the mainstream media. We have been through a lot of talks about the interest rates going up, a lot of talks about inflation, a lot of talks about recession. We're seeing in some markets, the residential market, the home prices are trickling down. So definitely the market is changing, right? And there's a lot of people, hey, are we going to burst a housing bubble? Are we not in a bubble or not? And all of that. I I like to look at the fundamentals, right? But also observe the big players in the market, what they're doing, what they're saying, what are the data that they are sharing, and consume that. I think that helps a lot. The more you know, the more parameters, the more clear direction you can have. So this is the latest report from Freddie Mae, and you can see they still see that the fundamentals for, and this is specifically for multifamily, are very well positioned, are very strong. The demand and supply, right? That's the number one equation that we look at. Is still very, very favorable to invest in multifamily. And here again, despite the growth that we saw in the last 2 years, it's still growing, it's still very, very solid. Another one that I want to share is this is again is a report from Marcus and Millichap. Marcus and Millichap is a 51 years old real estate, commercial real estate firm. They have 2,000 agents across 80 offices in US and Canada. So they really have a lot of their hands into this market. They have done more than 4,000 multifamily transactions. And so I always like to grab information, insights from the big players, and definitely they are one of those. And they're saying we are seeing a lot of capital coming even from abroad to the multifamily market, right? For a lot of reasons. And if you keep going, keep observing, that's another one, another news. This is from BlackRock, right? Um, BlackRock, they manage more than $10 trillion in assets. So they really have a lot of intel, a lot of access to primary data that me and you, we don't have that access. They have a firepower, right, to invest in virtually anything. And isn't that interesting that even BlackRock, when there is talks of inflation and don't know how long it's going to take us to control that, and all of this talk, they are coming to multifamily. and invest in this sector, right? So that makes me think, so well, if BlackRock that have access to virtually any type of asset class to invest, they also coming to multifamily. For me, is a signal that they acknowledge how robust it is, and if there is any signal of the market or the economy being more fragile, that hey, this is a safe harbor to invest your money, right? So just want to share a few of those data points. And Angela here stated very well. I like the way she stated why she likes to invest in multifamily and a bond-like return. That's who doesn't like that, right? And hey, if inflation comes, there is no better way to park your money, because this is an inflation hedge type of asset, because rents will adjust to inflation no matter what, right? So, and it's truly essential asset class, right? No matter what type of economy we are, we still need housing, and we still have a huge gap in this country. So I just want to start with that, just sharing some data points and outlooks of what's going on in the multifamily industry. We came today to talk about some tax benefits, and I want to start with this quadrant. And probably in many of you know this. This is the cash flow quadrant created and was really became popular after Robert Kiyosaki with his book Rich Dad Poor Dad, right? So these are the four quadrants where you have different economic activity to make your living, right? And you see in the top left, as an employee, you have a job, you work for somebody. And down in the S, as self-employed, you own a job, right? You can be a doctor and have your own practice. So you know you own your job. A business owner is like big business, and in this sense, it's like big business. So you really own a system, right, that can run by itself. You structure that doesn't rely on you personally or specifically to run, right? And then, of course, investor and essentially investors are making the money work for you, right? Even when you're sleeping. So these are the four quadrants. And what's really I want to call attention here is, if you're making good money as a W-2, as an employee, and maybe some of you are in this situation today, you might be paying almost 40% taxes, right? Easily. And when Chris was mentioning at the beginning, hey, taxes is your largest, or the government is your largest partner. That's what it is. That's what that means, right? And in this case, you are a silent partner. You don't have a saying that comes out of your earnings right away. If you're self-employed, it's even worse, which is crazy to think about it, right? You study more, you're getting your degrees, master degrees, PhD, and owning your business is a lot of work, a lot of sweat, and still you pay even more taxes. When you go to the business side and you own a big business, you pay much less. Of course, it varies from industry to industry, right? We're trying to give an idea here. It's about 20%. And we saw plenty of information, news of big companies paying sometimes zero, right? And investors, for the most part, if they have a solid strategy for taxes, they can pay zero, right? And why is that? Why that portion of the economy paying so much less taxes? If you go back to the history of the tax code in this country, uh, even the tax code itself, and there's a link here, you can go and check yourself. There is almost 6,000 pages of tax code, and just 1,000 of that is to tax the masses, right? The W2 class. And vast majority of the tax code is really about incentives, is really about giving breaks. And who they're giving breaks to areas that are extremely strategic for any nation to keep the nation strong, growing, and creating wealth. You have to create jobs. That's why the big business are creating new jobs, having incentives for that. Same thing with energy, right? We all see and how fierce is the dispute of oil reserves and other sources of energy. Food production, agriculture has tons of tax incentives, and housing, right? The government can't build housing themselves. They have to stimulate people, economy, investors to build housing for the nation as the nation grows. So these are sectors. They're not only that, right? But these are key sectors that have lots of incentives. So if you align your strategy to these sectors and you align that with really what the government wants you to do, you're going to get that tax break. And that can make a huge difference in the long run, how you build your wealth, right? Just think about the tax you're paying today. What if you're paying half of that taxes they're paying today? What you would be able to do to that money that you could invest elsewhere and create more income for you, right? Um, so that says the baseline to get a conversation going. And now I want to flip to, hey, let's compare and trying to be very practical here. There's a lot of numbers, so I'll go slow here. We are going to compare the same amount of investment and the same return. The amount is $1 million and the return is 10% per year. And we're going to compare what it takes, what is the implication of taxes when you do that with stocks and when you do that with real estate, right? So this yellow table is simply that. So I hope you can see my mouse moving here. It's 1 million they're investing, 10% return. Your returns of that in terms of value figure is $100,000, right? So these type of gains, when you look at the table for 22 long-term capital gains, assuming this is long-term, you're holding that stock for more than 1 year, at that level of 100,000, you are going, if you're married or even if you're single, you're going to be in this range here. This is the bracket that you're going to pay 15%. Here it is, the 15%. So you're paying $15,000 as capital gain taxes here. And on your pocket, you're putting $85,000, right? So this is very simple, very straightforward. Now what we are going to flip and use the same numbers for real estate. And in this example, that 1 million was used as a down payment. That's a capital, a down payment for a property that cost you 4 million. Okay, so this hypothetical, and 3 million was the loan, 4 million was the asset, the total price, sales price, and 1 million the down payment. So out of this 1 million, if you get 10% return out of that, it's the same $100,000 that you got in stocks. But now comes the depreciation, right? So the depreciation, I want to explain using this table over here on the right, right? So again, this is the property that you pay $4 million, 1 million down payment, 3 million loan. And as far as tax code, every property is split in 4 components. One is the land. The land is non-depreciable, and the land is about 20% of the value that you have paid on the property. Again, this is a reference. It changes from county to county, states to states. And the building itself, it accounts for 50% of the value of the property. So in this case, $2 million. And multifamily apartments, they depreciate in 27.5 years. That's the tax code, that's the law. If you do the math, 100% of the value divided by 27.5 years is equal 3.63% depreciation per year. If you apply this and you just multiply this for the value of the building, you're going to get $72,600 as depreciation for that year, right? That's the number that is here. So now your taxable income got reduced because you got depreciation, and now it's only $27,400. And of course, this building depreciation is paper depreciation, right? The building is there. Yes, it's getting old, and probably is appreciating, right, in value, and is not depreciating, and you're getting that break in that year. And in this example, now your taxable income is $27,000. If you go back to that same table, which is here, $27,000 is under the minimum threshold to pay capital gains here, right? In any of these conditions here. So you're paying zero. So in this example, right, using the same capital amount and the same return, you're putting more money on your pockets, right? Just because you're taking advantage of the depreciation. They're more into depreciation, and we are going to go into that right now. Again, we are going to take this diagram here as the property. So 75% of that was really the money that came from the lender, right? And you got $1 million that you put as down payment, right? Coming back to the point that, hey, it depreciates in 27.5 years, we'll talk about that. And you're going to apply 3.63% depreciation per year. So you're going to do that calculation over the down payment that you did, your capital that you put as down payment, the 1 million that we're talking about, right? So 3.63 over 1 million is $36,000. And no, that's not how that works. It's really the calculation, and the depreciation goes over the entire asset, the entire $4 million of asset. And of course, then we apply here what's the building, etc. But my point here is you're getting depreciation over the entire asset, even when 3/4 of that capital came from the lender, came from the bank. The bank is not getting that depreciation. You are getting that depreciation as an investor, right? So this is huge if you do the math and you put that into perspective. Hey, we talk about the 20% land, 50% is building. What's the rest, right? Is the other 30% is what they call land improvements Land improvements in multifamilies, parking lot, drainage systems, landscaping, all of these are land improvements. Content is the content itself, is really everything inside the building that makes the building function as a building. So toilets, cabinets, electrical panels, everything. So these are the other elements. Then comes the core of what we want to talk today, bonus depreciation. What is that? So again, I'll go back to this diagram here. This is the entire asset, right? We said that 30% of it is content and improvement. Half of that is the building, 20% of that is land. So the government signed a law, the president signed a bill into law in 2017 called Tax Cuts and Job Acts. And that was a bill with the objectives to stimulate the economy by reducing taxes for individuals, for the corporate, for businesses, and for real estate. And was almost 200 pages of a bill. And really, what matters here to us is that for real estate, the government is allowing you to take this 30% here, this piece, and depreciate that all up front in year one, all at once. Remember that the building depreciation is 3.63% per year, right? And you get that depreciation for 27 and a half years. This is going to go the entire 30% all in year one. If we remember in that example, we were talking about a $4 million property that we did the exercise that we just compared, right? If you do a simple math, 30% of that, 30% of 4 million is 1.2 million. So you could depreciate 1.2 million in year one. So for that, you need to hire a third party to do what they call a cost segregation study. And that essentially is accounting for this 30%, these content and improvements, and the company will account for that for your specific property and get you a report, and you use that report to claim that on your when you're going to do the taxes for that property, right? And what that means for you as an investor. A lot of numbers. I'll go very slow here. These are real numbers from a property that I invested myself. I'm sharing here personal investment information to show you how this works. This company, Green Summit, was the company that did the cost segregation study, okay? And this is the summary that they prepared. This property is really a portfolio of two properties, one called Berkeley, another called St. Charles here. We paid almost $18 million in this property. And as equity, we put 5.5 million. Equity in this case, think as down payment, right? So that was all the investors together. We pull all that capital and we put 5.5 down payment, and the rest we did alone. Now, look at this first row here for the Berkeley port property, okay? And you see the columns year 1 through year 6, and that can continue it, right, to 27 years, right? Just as an example to show you what happened here. You see the first row, you see 27 and a half year. This is the depreciation of the building. And this is the amount for that year 1 in depreciation. And then year 2, year 3, year 4, you see the same number, right? just year one, because of the date that you bought the property, right? You have to prorate that. And then you see here the second row, you see here bonus depreciation. This is that 30% that we talk about. That got 100% depreciated in year one. And this is the amount, 3.8 million. And then you see year two, 0. Year three, 0. That's what it is, right? We pull all that depreciation year one. So this is here, 3.8. Same thing for the other property, St. Charles. We bought it together as a portfolio, and you see the same process, same concept. We did the same here, right? So bottom line is we put as down payment as equity 5.5 million, and in year one we are going to get 5.3 million in depreciation, in write-off, right? So as an investor, this is the other table here, down here in orange. This is the example. What that means for you if you're investing as a passive investor in this project, right? So if you invested $50,000, that was the minimum for this project, you were getting year one 48,000 in depreciation. If you invest 100, it would be 96, and so on and so forth. So bottom line, you are having a 96% depreciation in year one compared to the amount of capital that you invested, right? So that's a huge benefit right there in year one. And of course, is what matters is where you can use that, where you can use that depreciation, right, to benefit you. Let me keep going here. This is, again, real data, a property that I invested in Alabama. And you saw the pictures here, was the first in the top left. This is my year one, and I invested as a passive investor, okay? I invested $50,000. And after we closed that year, I got this tax report. Every investor will get the tax report, and we call it Schedule K1. See the name over here? And you see this was just last year, right? And you see here my name, and this is the address of the LLC that owns the property, all of that. I invested 50,000, you see here. This table here is just an extract of this area of the form. So just to make it bigger to read, the loss was 56. So more than 100% in this property, right? So what I invested was 50 and I got 56 in depreciation, right? Every property is different. And again, you have to do the cost segregation study to account for that, et cetera, et cetera. So this, by the way, is one huge difference, and in my opinion, advantage for this model of multifamily syndication, bringing investors together, buying an asset. Everybody is an asset owner. Everybody is equity owner, and you're going to enjoy the depreciation for your fair share of investment, right? This is how this works here. In REITs, it's different. REITs, you are pulling money and not necessarily buying one property, you're buying a number of properties, and that is, I just dropped a juice here, and that is not transfer, the depreciation is not transferred back to the investors, right? You don't get this, you don't get the K1 like this. So in my opinion, that's a huge difference, and here is a huge advantage. What you can do to that, let's take into a use case here. Let's say this is a real property. Let's say this is yours. This is your investment property. You bought this house, you're renting, and you bought this house. This is Summer Mission, Washington State. This is public data, by the way. I'm not sharing anything private. It's public in Washington. This property was bought in 2012 by $265,000 and sold in 2021, last year, for almost $700,000, right? What is the profit? 434. What is the capital gains? 434 in this table, where that goes, again, 15%, right? 15% is $65,000 of capital gains that this person that sold this house will have to pay at the end of the year. Except if this person invested in, let's say, $100,000 in this project here and got 96,000 in depreciation. You get this depreciation and you offset this with the capital gains on your investment home that you sold. You offset one to another, right? So instead of paying the government 65,000, you're using that and you're redeploying that into another asset that, by the way, will generate income for you. So all the big investors and people that really understand these rules, they do this all the time, and they keep rolling, right, these forward. We all know depreciation is really a deferral mechanism, right? It's not that you're never going to pay the taxes. The government's giving you a break. When you sell the asset, they do the depreciation recapture, right? And they want to charge you that depreciation when you sell. Same thing here when you're selling this, right? But at that year, at that fiscal year, if you do another investment that have a big depreciation, you can do that offset again, right? This is one of many examples of how investors pay very low or zero tax because they understand the tax code, they understand where the incentives are, and they're doing all by the law, of course, and they are working accordingly to offset one thing to another. The use case number 2 is a house in Florida, in Bal Harbor. Same concept. This house was bought in 2018 for $3.9 million and sold this year in April for $8 million. So it doubled from 2008 to 2022 in 4 years. Double. And imagine this, 4.1 million in profit. This shifted to the 20% bracket, right? It's a lot. $820,000 in capital gains to pay in this transaction here. Again, if it's an investment home, right? Hey, if you take this as an example, right? And let's say, hey, I'm gonna redeploy this money. Instead of paying the taxes, I'll get part of this profit, the 4.1 million profit that I got. I'm going to invest part of that in a multifamily apartment. So you see here, year 1, investing 855,000 out of the 4.1 million here. And let's say you're getting a depreciation like this example that we use here, 96%. Every case is different. Could be 90%, could be 85%, still a lot. You would get, right, $120,000 in depreciation, which offset these capital gains here, right, that you would pay. So with that, you are not paying that. You are redeploying, as I said, in another investment, in another income producing asset. And you, let's say, that property is giving you 6% cash on cash return per year. So you would get $51,000 in return out of this investment instead of paying 820 for the government on that transaction, right? That's the power of uh, investing in real estate, and more so understanding bonus depreciation, understanding how these tax mechanisms, incentive work, and have a strategy for that, so you can capitalize on that. That can take your wealth building way, 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 way quicker and to a whole different level, right? If you do the right thing. So in 5 years, here's just to show the example, in 5 years, that would accumulate just in cash flow another $250,000. And probably at that point, with that money, you could buy another single family home if you want, or redeploy that in another multifamily investment or property, and keep building in a compound way, right? Your wealth. I think that's really the power of it. Important to understand, this law was signed in 2017, and when that was signed under a condition to phase out gradually, right? And this is the table. So what that means that 2017 was signed, and they kept offering that 100% bonus depreciation over the land improvements and content, right? Until the end of 2022, this year. This year is the last year that we can enjoy 100% of that depreciation coming forward. Next year, we'll drop to 80. Still a lot, right? Still a lot of money, still an equation that makes a lot of sense. Still 60, and so on until it fades out completely, right? What the government is going to do in the future, we don't know, right? If you ask me, my guess is, if the fundamentals keep like they are, and we still have a huge gap in housing, in supply, and it's not easy to catch up and build, especially with the supply chain disruption that we are still dealing with, and labor shortage and all of that. Will not be easy to catch up on supply. They will have to do, in my opinion, the government, to keep having some sort of incentive. Might not be this one, might be another one. They might extend this. I don't know. Nobody knows, right? But if I would guess, I would say they would have to do something to keep investors interested in keep building and keep investing in housing, right? All right, that was it. That what I had prepared to present. We're gonna have time for Q&A, and before that, I just wanna leave you my contact information. If you wanna contact me, you see in the very top in blue my email, and then you see my website of my company, Multifamilypedia. It's very simple. It's a landing page, but you can schedule meetings, or you can also register with us and stay in the loop. You can also scan the QR code here with your cell phone while we have this on the screen, and that will take you to what we call the investor profile. If you fill your information, you get into the database, and whenever we have an opportunity to invest in another asset, we communicate to our investors, so you are going to be notified if you desire to. So this is my contact information. I want to thank you, Chris, for the opportunity to come today and then talk on your virtual meetup. Was a pleasure to be here. And with that, I'll give back to you, Chris. I think we have time here for questions if you want, but
Yes.
we're done with the content.
Anderson, that was fantastic, and I'm sure some of our colleagues on the phone here may have some questions, and I want to turn it over to them. But while we do that, let's leave your information up here so that people can can record it, scan the QR code, take a screenshot with you, whatever you want to do, so you can reach out to Anderson, and of course, Anderson, will capture your I'll provide all of your contact information to all of the tonight's attendees. But that was terrific content. Let me turn it over to our guest here, and anyone with any questions or comments based on what they've seen tonight, anything that you'd like Anderson to reply to, please go ahead and take yourself off mute and ask your question.
Chris told me nobody's shy here.
I know we're running short on time, so I won't ask a question. I'm just going to say that was so awesome. Thank you, Anderson. I've heard of this whole concept of cost segregation and accelerated depreciation and all that before, but I was never able to wrap my head around it. You just explained it so well, and my mind is blown. So thank you.
That's great to hear, Scott. Yeah, and Scott, keep learning. Really, guys, the magic is on the details, right? And how we plan to build our wealth. And hey, we have to have a tax strategy. It's too large. It's just too much tax to ignore that part, right? We have to be thoughtful ahead of time. How you going to do things in a way that you can be more tax efficient, right? Just that. We want to be tax efficient. How I can play with that in a way that helps me build my wealth more quickly.
Absolutely. And Scott, I'll tell you, it was about, and Jim, go ahead. I'll jump in after you. Go ahead, Jim.
Go ahead, Chris.
No, please.
Now, Anderson, I agree with what Scott just said. It's so many topics in there that I've sat through multiple presentations to see it all brought together in live examples. It was brilliant. And I appreciate it. Made a lot of clarity for me on something. I have a colleague that is trying to sell a home here in Florida that's in that, not as much as the $4 million project, and I'm trying to convince him, instead of, he wants to reinvest it in another house, and I'm trying to have that explanation, having this content's going to be great if I can use that, Chris, when you send it out. Well done, Anderson.
No, thanks, Jim. I'm
Thank you
glad,
for taking
guys.
the time to meet with us tonight and do that.
Oh, absolutely. No, thanks to Chris. Chris is the connector here, but I'm glad to hear, guys, that that was helpful, because I also struggle with that, right? Tax can be complex, right? And it's boring, right? To really get into the weeds of that, right? So the group that I'm part of and the other syndicators, so I learn a lot from them too, right? What I'm doing here, I'm pass it on, right? So I think more of us have to understand this. It doesn't apply to everybody, right? Not everybody will do that. That's okay. But at least you know that is an option, that is possible. And a lot of people do that, and it's perfectly as part of the context of the tax code. So we just wanted to understand that, hey, I have another option here to have a better tax strategy for me. So
Absolutely. And Anderson and Jim, you guys are both in the tech industry. So you guys will have to, when you guys exchange later, you can chit chat a little bit more about that. But what I was going to say is when I learned this a few years ago, when I first started getting into multifamily, I was in a meeting very similar to this, on a meetup, learning about this, and it blew my mind. And what drew me to multifamily real estate in particular, as a high net worth individual, a high income earner, with my pharmaceutical career, getting killed with taxes, living in a high income tax state like New York, being in an industry that is very scrutinized, I was really very much interested in finding ways to legally mitigate and reduce my taxes. And again, a lot of what I always like to draw back to is often when we look back, and this is not a political statement at all, but when we look back to that presidential debate between Hillary Clinton and Donald Trump, and there's this back and forth that they had, and in that statement, Hillary Clinton made some comment about Donald Trump, not paying any taxes. In that moment, he said, "Hey, that's just because I'm smarter than you." And looking underneath all of that, you may discuss you think about his business in real estate and how what Anderson has just outlined for us, and how he's playing a different ball game in the billions of dollars, and being able to do this and have income that is taxed differently or very little in comparison to all of us who are earning our income either as W-2s, or sole proprietors, or some of the other areas where it's a higher income tax. And so once you start looking at those things and start applying what you learn, the game will start to change with you. And that's why I'm so grateful for folks like Anderson to invest their time to share with us these important elements. You don't learn these things in school. You don't learn these things and after school. You have to seek out this information and improve upon your self-education. And this is what you guys all took an hour and some change out of your day to do after a long week. These are the types of things that are game changers that will continue to change yours and your family's financial well-being and trajectory. So thank you guys for taking the time out. I don't want to rush us off here. I'll hang back for anyone that wants to continue chatting. I'm going to stop the recording here so people can speak